Introduction to Accounting. Accounting is treated as the language of business. It records all the transactions which can be measured in money and have occurred in a particular period. Accounts of a business provides useful information to its users. It follows from the previous slide that after studying this lesson, you should be able to understand the meaning, importance, and objective of accounting, describe the meaning of accounting principles, explain the accounting concepts, conventions, and generally accepted accounting principles, analyze the accounting process, know the preparation of final accounts. The main object of a business house is to earn profit. Accounting is the medium of recording the business activities and is considered as a language of business. To find out the results of a business, the information relating to the cost of the products and revenues from the product are collected. Then the costs and revenues are compared to find out profit or loss of the business. The main objectives of the accounting are to record the business transactions and to provide the necessary information to the internal and external users of the financial statements. For the said objectives, the accounting is classified into financial accounting is the original form of accounting. It refers to the recording of daily business financial transaction. Recording of the transaction is done in such a way that profit of the business may be ascertained after a definite period, and the picture of the financial position of the business may be presented. Cost accounting is related with ascertaining of the cost of the product in a period. Under this system, record of raw materials used in production, wages and labor paid, and other expenses incurred on production are kept to control the cost. Management accounting provides the necessary information to the management. Is called management accounting. Under this, the analysis and interpretation of accounts prepared by financial accounting are done in a manner so that managers may forecast, plan for future, and frame the policies. Under tax accounting, the accountants prepare the accounts as per the provisions of taxation. The accounts prepared as per taxation provisions may differ from the accounts prepared as per financial accounting. Human resource accounting means the accounting for human beings as, now in an organization, human being is treated as an asset, like any physical asset. It is recorded in the books like other assets. HRA deals with the measurement of cost on recruiting, selecting, hiring, training, placing and development of employee on one side, and on the other side it deals with the present economic values of the employee. For the determination of the value of human being, different methods are used. Under HRA, responsibility accounting is a special technique of management, under which accountability is established according to the responsibility delegated to the various levels of management. A management information and reporting system is instituted to give adequate feedback in terms of delegated responsibility. Accounting is both the science and art. Study of science is based on some principles and is systemized. It is a science because the business transactions are recorded on the basis of some principles and journal of transaction. Ledger posting, trial balance, and preparation of final statements are done in a sequence. Art is the creation of practical application and rules of accounting. But also, we learn to apply these principles in practice to record the business transactions. Thus, accounting is both. Main purpose of bookkeeping and accounting is to furnish the necessary financial data to the persons interested in the business. These persons can be internal and external users of the business. The objectives of accounting are to maintain the systematic records of the business, ascertain the profit or loss of business, present financial position of the business, and provide financial information to various users for the development of commerce. In the present economic and social environment, the importance of the study of accounting theory has increased, as all the financial statements are prepared by accountants on the basis of this theory. Hendrickson defined the accounting theory as logical reasoning in the form of a set of broad principles that provide a general frame of reference by which accounting practice can be evaluated and guide the development of new practices and procedures. Thus, theory includes the systematic principles and methodology which are used in the practice. The cash flow statement summarizes all activities in the cash accounts of the corporation. The statement user can imagine that if one had access to bank statements for the year, the cash flow statements could be created by sorting all transactions and summarizing them into categories. The checks would be sorted by what type of bill was being paid. The deposit would be sorted by the source of the inflow, and the resulting statement would create a cash flow statement in what is called the direct method format. This is the format presented on the screen. In the direct method format, each line of operating activity section represents a sum of all checks or deposits in a particular category. For example, the operating activity section would include such items as cash received from customers, cash paid to suppliers, cash paid for interest, cash paid for wages, cash paid for research and development, cash paid for selling, general and administrative costs, and any other relevant summary line. The investing activity section would include such items as cash paid for acquiring capital assets and cash received from disposals of the same class of assets. Also included in this section would be the cash paid to invest the stock of another firm, as well as the proceeds from the subsequent sale of the stock. The financing activity section would include cash received from stockholders, investing in the firm, and any cash returned to stockholders, whether in form of stock repurchases or dividends paid. The liability component of financing activities would include cash received from debt holders who have loaned money to firm during a period, and any principal payments made by the firm to these debt holders. To maintain the records of business transactions, an adequate system of accounting should be maintained. As per the principle of double entry system, each transaction of business is recorded at two places. In other words, two entries are made for every financial transaction of the business. If someone is giving something in the business, it has two sides. One is giver and the other is the receiver. The system of double entry can be understood easily by an equation which is called accounting. An account is a statement in which the date-wise details regarding business transactions as persons, companies, representatives, assets, liabilities, income and expenditure, and profit and loss are given. For the purpose of ruling of debit and credit, under double entry system, the accounts are classified on the basis of two approaches: American approach and English approach. As per the American approach, the accounts relating to financial transactions are classified as assets account, liability accounts, revenue accounts, and expenses accounts. Under English approach, accounts are classified in the following three categories: personal account, real account, and nominal. The accounting process includes the identification of financial transactions, recording of them, and summarizing. Thus, after identifying the financial nature items, the first step of accounting process is recording the transactions. The book in which these transactions are recorded first time are called books of original entries or record. These books of original records are memorandum book, journals. These books of original records are memorandum book, journal, and subsidiary books of original records. When a transaction takes place in business, it is first roughly written in the memorandum book, chronologically for the memory only. Then after some time, these transactions are recorded in the journal and subsidiary book. After recording these transactions, the book is destroyed. Therefore, it is called waste book. Journal is a primary book of original entry for accounting data. In the journal, the business transactions are recorded chronologically. That is called journalizing. Thus, the accounting data are recorded first time in this book. If all the transactions of business are recorded in journal, it will be too bulky to manage. Therefore, nowadays original records are maintained in the subsidiary books. These subsidiary books are also called subdivision. Journal of a business is very useful, but it does not reply the different queries as how much amount is due from debtors, how much is to be paid to creditors, and what is the balance of a particular account. For the reply of all these queries, the ledger is prepared from journal entry. Ledger is a set of accounts in which all type of accounts are kept. There can be two forms of ledger: bound ledger and loose leaf ledger. The process of transferring the entries from journal to ledger accounts is called posting. In other words, account-wise selection of debit or credit items and recording them into relevant side of the relevant account is called posting. The process of posting is done after a period of a week. The process of posting is done after a period as week, fortnight, or a month. For example, if rent as an expense is shown in the debit in journal, this will be posted in the debit side of the rent account in the journal. The pro forma of a ledger account is given on the screen. At the time of posting of transactions from journal to ledger, the rules to be kept in mind are: number 1. The debit side of ledger account, the word to is used while the credit side word by is used. Number 2. All those accounts are opened in the ledger which are given in the journal. Number 3. All the debit items of an account given in journal are posted in the debit side of the respective account, and all the credit items of an account given in a journal are posted in the credit side of the respective account. The name of the account in which posting is being made is not written, but the posting is done by the name of other account given in the opposite side of the entry in the journal. Number 5. At the time of posting, if the page is full and account is not complete, its total is carried to the next page and then remaining posting is done. There can be several transactions relating to a particular account at different places in the journal. Such transactions are collected and recorded in the concerned account. At the end of the accounting period, the businessmen become interested to know the position of these accounts. The position of an account is determined by calculating the net balance of the account for which debit and credit sides of the account are totaled separately. If total of the debit side is greater than the total of the credit side, difference is written in the credit side of the account and that is carried to the next year. If the total of credit side is greater than the total of debit side, difference is written in the debit side and carried to the next year. Thus, totals of both the sides become equal and a trial balance is a list in which all the balances of the account of ledger are shown to test the arithmetical accuracy of the posting in ledger. It is prepared after the end of a particular period, year, half year, or quarter. Trial period prepares a base for the preparation of final accounts. Generally, 3 columns are made in the trial balance. The first white column is kept for particulars of accounts, and the 2 columns for debit amount and credit amount are made. A trial balance is prepared by the following 3 methods, which is balance method, total method, and balance and total method. The balance method is the most popular and statutory method to prepare trial balance. Under this method, all the accounts are recorded. If an account shows a debit balance in the ledger, the balance is recorded in the debit side of the trial balance. And if it has a credit balance in, the credit side of it is written. Repeat. If any account has no balance, means its total of debit side is equal to the total of credit side. It is not recorded in the trial balance. After recording the balance of all accounts of ledger, the amounts of both sides are totaled to check the arithmetical accuracy of the ledger. If the total of the debit side agrees with the total of the credit side, it proves books are at least arithmetically correct. There are 2 types of errors. Errors which cannot be located by trial balance, like error of omission, error of commission, error of principal and compensating error, and errors which can be located by trial balance, like those relating to totals of subsidiary books or ledger accounts, balancing of an account of the ledger, wrong posting of any amount in any account. Posting of any account may be in the wrong side of the account. Balance of any account may be omitted in writing in the trial balance. Wrong total of the trial balance. In spite of being a difficult job of distinction of capital and revenue items, some rules are framed for the recognition of these items. Expenditure of business are classified into capital expenditure, revenue expenditure, and deferred revenue expenditure. As distinction is made between the capital expenditure and the revenue expenditure. Similarly, to calculate the accurate profit or loss of the business, distinction between capital receipt and revenue receipt is done. Capital receipts include the sale of fixed assets, long-term investments, issue of share capital, debentures, and loan raised. Capital receipts are different from the capital profit or loss. The entire amount from the sale of assets is called capital receipts. The difference of sale proceeds and cost of asset is capital profit or loss. Revenue receipts are obtained during the normal course of business are called revenue receipts. In other words, the receipts which are not capital receipts are revenue receipts, as sale of goods. Revenue receipts are different from revenue profit or loss. Depreciation means the fall or decrease in the value of assets. Depreciation is a permanent in the value of depreciable assets on using in the operations of business. In the depreciable assets, land, forest, goodwill, livestock, R&D are not included. Generally, there is a depreciation in all fixed assets due to some reason. There are few cases in which the value of assets appreciate, as land, antiques. Final accounts are prepared from the various balances depicted by the trial balance. Some balance of the trial balance account are used to prepare the trading account, and some for the preparation of profit and loss account, and the remaining balances are transferred to the balance sheet. Thus, all the balances of accounts of the trial balance are used in the final accounts. Therefore, the preparation of final accounts is the final stage of accounting. Trading account is the comparison of sales and purchase. This account is prepared to determine the amount of gross profit or gross loss on sales. Profit and loss account is the second part of trading and profit and loss account. Trading account depicts the gross profit, which is the difference of sales and cost of sales. Thus, the gross profit cannot be treated as net profit, while the businessman wants to know how much net profit he has earned from operating activities during a period. For this purpose, profit and loss account is prepared keeping in mind all the operating and non-operating income and losses of the business. In case of trading activities only, the trading and profit and loss account is prepared to compute the net profit. In case there is a manufacturing unit in the business with the trading, such a businessman's income statement will include manufacturing account also. Manufacturing account is prepared to know the results of manufacturing unit, that is, cost of production. This account is prepared before the trading account. the balance of this account is transferred to the trading account. After the determination of the net profit of business through the trading and profit and loss account, the businessman wants to know the financial position of the business. For this purpose, he prepares a statement which is called balance sheet. The balance sheet depicts the financial position of the business and fixed date. A balance sheet has two sides, asset side and liability side. Order of presenting the assets and liabilities in the balance sheet is called marshalling of assets and liabilities. A balance sheet may be prepared by marshalling the assets and liabilities in order shown on the screen. When a balance sheet is prepared on the basis of liquidity order, more easily convertible assets into cash are shown first, and those assets which cannot be easily converted into cash are shown later, and so on. Repeat, the pro forma of such a balance sheet is given on the screen. Balance sheet prepared under permanency order is the reverse of balance sheet prepared in liquidity order. In this case, first those orders are shown which are more permanent, means fixed assets, and then less permanent assets are shown. Similarly, first long-term liabilities are shown, then less permanent liabilities are shown. The pro forma of such type of balance sheet is given on the screen. Final accounts are prepared from the balance of trial balance. The final account will show the true and proper picture of the business only when all the transactions of the business are properly recorded. Therefore, before preparation of final accounts, the accountant must see that all the transactions of the current year have been recorded properly in the books. Now let us check if we have understood the various concepts discussed in this lesson clearly. Credit shows the receiver in personal account. Right or wrong? Please click. Wrong. Double entry system refers to account which is based on the two aspects of transaction. Right or wrong? Please click. Right. Debit shows the giver in personal account. Right or wrong? Before we end, let us briefly revise what we've studied till so far. Accounting is the medium of recording the business activities and considering a language of business. Journal is the first book of original entries in which all the business transactions of the financial nature are recorded, then posted to ledger accounts. Accounts are of three types: personal, real, and nominal account. Final accounts include the trading and profit and loss account and balance sheet. Trading and profit and loss account is prepared to calculate the net profit earned by business during a period, and balance sheet of a business is prepared to disclose the financial picture of the business.